Are looking ahead to the U.S. Federal Reserve Board's interest rate decision this afternoon. They'll be eager to hear anything the Fed has to say on the future path of rates. Our next guest believes some economic indicators are pointing towards a U.S. recession. For more on what that means to investors, we're joined now by Phillip Toews. He's CEO and portfolio manager at Toews Corporation. Phillip, thanks a lot. What indicators do you see that may be pointing to a recession, and will that lead the U.S. Fed to reduce rates in 2024?
Well, so we've got these divergent data sets. One of them is very strong GDP and some strong employment numbers, which make it look like, well, when you consider that with the possibility that the Fed will lower rates, makes it look like it's all clear ahead and risk assets are the place to be. However, leading economic indicators in the United States, when it's dropped as much as it has, around 3% recently, has always led to a recession. And so that's one indicator. And the other thing we look at is the fact that in the past, when rates have increased as much as they have, that has also led to a recession. So sometimes you have these very lagging effects. Frankly, before the financial crisis, it was over 18 months from the last hike before the stock market turned lower, and even longer before we entered into a recession. So it's a story of two worlds, and there are these divergent possibilities. That latter thing, though, the leading economic indicators and rising rates, those two things, I think, create a very strong risk of recession coming in the next 12 months.
One thing you think investors should consider is taking a position in hedged equity funds. That sounds like some equity exposure with some hedging to blunt downside risk if we do get a move down. Talk to us more about that.
Absolutely. So if the latter of those two things happens, which is it's not all clear ahead for risk assets, and we see the market turn lower for whatever reason, that could be ignited by reemergent CPI or just the fact that conditions are relatively tight right now, stocks could move down further. And so from the starting place, like if you go back from December of 2021 to where we are now, stocks are still down a bit, especially if you consider the effects of inflation on that. So if stocks move down further from here, if we see a reignition of downward moves in risk assets, I think you want to be hedged and try to have less loss than the market generally. So really what you want to do is, we call it have your best friend temporarily, not your BFF, but your BFT is be in the stock market, but have a way to have some kind of offsetting appreciation, potentially from options in some of these hedged equity ETFs, hedged equity mutual funds, to allow you to be in the markets but address contingencies.
Do you have a call on whether a long and deep recession is likely or a short and shallow recession? I think most forecasters, if they see a recession coming in the U.S., are on the short and shallow end. And if so, what does that mean to the path of equity markets? We often hear that during a recession, when the market gets clear signs of the recession easing, markets tend to rally.
Well, so we don't have a call whether it's a soft or a hard landing, but I think that you should prepare for either contingency. I mean, I think that's the whole point, is that most, especially people that are near a distribution phase for their portfolios or in a distribution phase, can't afford a big downturn in the stock market. So address either contingency. Going back to what I was referring to before, which was when the Fed hiked back between 2004 and 2006, it took all the way till 2008 before we saw a significant recession. And obviously we know what happened to the stock market there. So, hard landings can come, and markets are so unpredictable. At this stage, it's very difficult to see a recession because employment, as we saw recently, was good here in the United States, and GDP is so strong. So those things can be very lagging indicators.
You also think investors should have exposure to bonds, where things look a whole lot differently than they did a few years ago. Talk to us about the bond strategy you think works.
It's a new world for bonds. And what's been happening in the marketplace is you've seen $1 trillion or so go into T-bills and very short duration bills, but that's based on the past. So unless you can go back in time, Paul, I think you need to change your focus on fixed income. So, talking about those different scenarios, if you have either a hard landing scenario or a soft landing scenario, that means that clearly the Fed's going to be lowering rates. And if that's the case, bonds historically have done quite well during a time when the Fed is lowering rates. I mean, we were just looking at some data here where, ag bonds, aggregate bonds or investment grade bonds can move up 20, 30, 40% during a Fed lowering environment. So it's a very different world than it was 2 years ago. Yields are much higher. And so, going to the other scenario though, so if we happen to still have benign inflation, but we don't have any kind of a landing, bonds still are going to do okay and likely better than T-bills. So we think that could be the potential savior of a portfolio if risk assets turn south here.